want to move on to bonds and talk a little bit. We've seen bond ETFs, great inflows this year as well. We just put up a screen about that. You have an active high yield fund that's seen inflows. Prices have held up. To me, this is quite amazing. It would seem this is a good sign, because if there was an imminent turn down, folks, high yield would sell off, right? I mean, it's credit, and it's risky credit.
Well, I think that the health of the credit markets is in some of the best shape that it's been. When you think about the last few years and where we've seen the move by a lot of companies and how they're treating their books from a credit perspective, the yield that you're getting off this is still really attractive. The yield to worst in the high yield space is usually highly predictive of where the credit markets are going to go in the 3 to 5 years in front of it. So I think what we're seeing is a continued interest in the health of high yield and what that can look like in a portfolio as investors start to think about how to redeploy some of this cash that has frankly been sitting on the sidelines for quite some time now. It's
amazing to me how much the viewers, investors in general, love their short-term. You have a short-term one too. Even though yields are coming down, we still see inflows into your ultra-short income ETFs. They love these 5% yields, but they're coming down. Even as they're coming down, it's remarkably sticky. Money market funds are holding up $6 trillion very well. They seem comfortable even at a lower level.
Well, I think what we see...
There's a behavioral psychology thing going on here. They still perceive there's a positive inflation-adjusted yield there.
Well, there's still, I think, a view, too, in the ultra-short space that is a...
And here's your ultra-short.
Increasingly, a better play than money markets, because when rates do decline, they tend to go very quickly in the money market space. They'll decline faster than you'll see in general in that ultra-short income space. So for those that want to stretch out their duration a little bit, who might not be convinced of completely which way the market's going to go, that ultra-short leg has been, I think, a good transition phase, and that's what we're seeing. We're seeing either people go into the ultra-short, or they're just going out to long duration and just saying, okay, I'm going to try there.
You're still over 5% on this ultra-short here, right?
I believe so.
Yeah, I think it's 5.5, as I recall, somewhere around there. I mean it's really remarkable.
It is, and I think what the conversations we're having, I don't know how much you're hearing about this, Todd, is also this a little bit, balanced is back, right? Which we haven't had that in a lot of years either. This thought that I really do need to look at both sides of that equation. I mean, people have been so focused on what's going on with rates and when are rates going to fall and what should I do in the fixed income portfolio and should I move out of cash now or later. Meanwhile, there's been 25% run in the last 12 months on the equity side of the books, and folks that sort of took that balanced approach have been in a pretty good place over that time period as well.
And we've seen the benefits, what they offer is an actively managed ultra-short bond ETF. So we've seen investors been embracing active strategies like Year, which Noel's team has, firms like products like Mint from PIMCO, JPST from JP Morgan, these ultra-short active fixed income ETFs that can go outside of treasuries to be able to find the best reward for that.
Well, explain that a little more. By the way, ultra-short is what, 30 days? What are we talking about mostly?
It's 1 year or less, right?
1 year or less,
okay. They'll flex, the products will flex anywhere from 6 months
right, and when they
year.
can go outside of treasuries, what percentage would this have, for example, in a outside of traditional?
Again, it's going to vary by time period. We're very focused on our particular product on the liquidity piece, because you want to make sure that in sort of periods of volatility or steadiness, whatever it is, that the liquidity is there in an ultra-short product. So things like securitized might only be 5% of our portfolio. There's going to be treasury repos. There's going to be a little bit of money market exposure there as well. So there's always going to be a blend just based on what's going on within the course of that year. And we'll dial duration up. Again, you might have a few pieces in there that'll go over, but on average, you're going to be at that 1 year or less. We'll go as short sometimes as down to 6-7 months duration, or we toe the line right up to a year.
So it's actively managed. It's not a money market fund where you're almost entirely. I mean, if it's a government money market, by definition, you're entirely
right. But it's also not billed like the State Street product that's just treasury oriented. The benefits of active management is they can find where that best reward opportunity is from a liquidity standpoint, own corporates, own CP.